Hi everyone. Welcome. We're going to start now. I just click the recording, so we're going to record this session. So should any of you encounter connectivity problem along the way, keep on trying to log on, but nevertheless, just know that the recordings for this session or any other session that we're going to have for this semester, you'll receive it. You'll receive it. So once again, welcome. Under these difficult conditions, you know COVID is still much alive. So it looks like for second semester, this is how we're going to run our academic year. Similar to semester one, but nevertheless, we need to proceed so that we can finish or finalize this academic year. Today, we're going to start with our first topic for semester 2. But before I start with that, let me just start with some of the admin side. So we're going to have classes twice a week. We're going to have classes twice a week. We'll have a class on Monday from 12:30 until 2 o'clock. And another class will be on Wednesday from 2 until 3:30. So this is as per the timetable, and all classes until such time things changes, we're going to conduct them through online. And the other thing that I can mention is that if it happens that we don't have any classes due to any reason, connectivity, load shedding, and so forth, we will reschedule that class, and we'll make sure that we reschedule it in a time where everyone is available. For example, if today happens, it's a Monday, we're having a class, when we're just starting, load shedding goes, then we can reschedule this class at a later date, probably at night. And the other thing that I need to mention is, if it happens that we see that we are behind and we have a lot to catch up, we will also have additional classes over and above these two classes. So during this session, if you have any question, you are more than welcome to use the chat. Type the chat. If you want me to repeat anything, you're more than welcome to type on the chat. We'll check the chat and respond as such. I believe all of you have received the study material that we're going to use for today's class. If you haven't received it, after class, this material is going to be uploaded on my tutor. So going forward, we'll make sure that the material that we're going to use for a class, it will be sent via the class reps, and it will also be uploaded on my tutor so that you have it. So what is expected from you guys is that you must go through the material before the class. You must go through the material before the class so that you can benefit more when we have classes, so that we can clarify any way you don't understand during the class. So, but since this is the first class, but I've sent the material via the class rep last week as already. So I believe most of you will by now have received this material that we're going to use. It is only one example that has been provided for Wednesday class. Today or later on or tomorrow morning, you should receive the material so that you can go through it before the class. All right. Now let's start. I've just shared a screen. I hope everyone can see the screen. So it is a screen where it's written Financial Accounting 3, FAC 31BT, changes in accounting policies, estimate and errors. I hope you guys, you can see that. Just let me know, you can type there on the chat if you can see what I've shared. Can you see what I've shared before we proceed? All right, thank you. I've got the indication that yes, we can see what I've shared. So the first topic that we're going to deal with in this semester is changes in accounting policies, estimate and errors. This is International Accounting Standard number 8. And I know that in level 2, you did this topic. And I know that in level 2, I think the focus was on estimate and errors. I stand to be corrected. But I know when I spoke to the lecturers from level 2, they told me that indeed this topic is one of the topics that is done in level 2 and tested as such. So when you come to this level, it is just a continuation. Everything that you've learned in level 2 will still apply in this level. So this topic is very important. It will be tested in the test, assessment, and final assessment. So when I say test, assessment, and final assessment, I think the formal communication will be communicated to you students as to how are you going to be assessed during this semester. So at the moment, I wish I had all the information to tell you as how you're going to be assessed, but as we go along, I'll tell you, and I believe you will receive communication, formal communication from the university as to this semester, how are you going to be assessed? How are you going to be assessed? So that will be clarified as we go along, but what I can tell you is that this topic, changes in accounting policies, estimate and errors, it will be tested either on a test or on the final assessment, which will be the exam. All right, let's proceed. So by the end of this topic, this is what will be expected from you guys. This is very important. So whenever we're dealing with a topic, you should know what is it that it will be expected from you as a student. So for this topic, which is changes in accounting policy, estimate and errors, you will be expected to prepare the statement of profit and loss and other comprehensive income, statement of changes in equity, and you will be expected to prepare and disclose a note when it comes to change in accounting policy. And lastly, what is going to be expected of you is to calculate income tax expense and taxable income. So you will realize that when it comes to accounting, though we did income taxes in semester 1, it carries throughout all the topics. You will see even the coming topics, income taxes will still be asked. The same principles that we've used in the topic income taxes in the previous semester, we're still going to use it here. So this is what will be expected from you guys. And please, I need to emphasize this. I've seen people who doesn't know how statement of changes in equity looks like. And at this level, level 1, level 2, they've shown you when we say statement of profit and loss, this is the structure. Statement of changes in equity, this is the structure. Note, this is the structure. So it is important that you know as to what information needs to be disclosed in these statements. Statement of profit and loss, I believe this is the easiest one. We all know how to calculate statement of profit and loss and other comprehensive income, but from time to time, when we're marking the scripts, you will receive shock of your life. Someone doesn't even know What is the difference between these statements? You ask statement of profit and loss, they give you statement of financial position. That on its own, you're shooting yourself in the foot. 0. When I'm marking, it's 0 because I requested you to prepare the statement of profit and loss. You went and prepared the statement of financial position. So revisit this. On the material that we're going to give you, you will see what we mean by statement of profit and loss. As accounting students, I know that most of you by now were expecting that you know it because you learned this thing from level 1, if not from high school. So we know when we say statement of profit and loss, we have expectation that you know how to prepare it. If not, go and have a look at it. All right. As I've indicated, today focus will just be in changes in accounting policies. So the topic on its own, it states changes in accounting policy, estimate, and errors. There are 3 parts to this topic. Today focus will just be in the changes in accounting policies. That's what we'll be dealing with. In the next sessions, then we'll deal with the remaining errors and estimate. So at this level, when it comes to changes in accounting policy, you will be expected, or we're going to cover change in inventory valuation and change in borrowing cost treatment. For today focus will just only be in inventory valuation. Again, I must emphasize that make sure you understand these principles or these guidelines from International Accounting Standard so that it will be easy for you to apply any information that you're given. From time to time, I receive message from the students who say, but sir, the example that you gave us was simple, but the test or the exam was difficult. And my argument remains the same, that as long as you understand the principles, you can solve anything. What do I mean by that? So if they say prepare statement of profit and loss, and you know that for you to calculate profit, you will need revenue less cost of sales, that will give you gross profit, add other income, less other expenses, profit before tax, less income tax expense, and you get profit for the period. So that's how you know. So that's the framework. That's how you know. So the fact that in example, you were given revenue and in the test you're not given and you need to find out how much is the revenue, then for me that says that you can, I mean, you're just solving X or the missing leg. So whatever we're going to give you in the example, if you understand it, I can assure you that you will be able to solve each and every question of changing accounting policy, and specifically what we're going to deal with it today, inventory valuation. Let's proceed. So the way we're going to start with it, I'll explain on a high level the principles of change in accounting policy, and then later on we'll look at the example and we should be able to apply everything that we were talking about on the principles. Accounting has principles. Accounting has standards. So you will have seen here, I've indicated that International Accounting Standard number 8 is the one that deals with the changes in accounting policies, estimate and errors. So all the principles, we're going to get them in this standard. What we did here, we summarize what is applicable. But when you have time and you want more information regarding the standard, which some they're big, some they're short, you are more than welcome to download it. You can get them online and you just go through the standard just to get a feeling as to what this standard is all about. But what we're going to do here, everything that is applicable for this course, we will go through it with you. All right, let's proceed. So we'll be done in no time with the principles, and later on when we go to the class example, we should be able to see how do we apply those principles that we were looking at? So now let us look here. When can the company change its accounting policy? This is the most important question. When can the company change its accounting policy? There's a lot of policies. Inventory has policies, revenue has policies, leases has policies. But the focus for today, as I've indicated, I say, we're only going to look at inventory. So you will know that in accounting, there are various policies you can choose. You can choose first in, first out method, which is called FIFO, last in, first out method, which is LIFO, and weighted average method. So how do the company select those policies and apply them? And now at this level, we're saying to you, what would be the impact if the company changes the accounting policy from one to the next? That's what we'll be doing. That's all about the changes in accounting policy. So coming back to this question, when can the company change its accounting policy? The standard stipulates that a company is required to change its accounting policy. Firstly, if it is required by the statement of interpretation. What it means here is if the IFRS board, if the International Accounting Standard Board decide to change certain standard. For example, we were doing leases in the previous semester and we call it IFRS 16. That is the standard. Previously, it was used to be called International Accounting Standard number 17. So the standard was changed by the International Board. So it is compulsory. So the International Board will state that from this date, you must apply the new standard or the revised standard. So this is when you can change the accounting policy, when you are requested to do so by the International Accounting Standard Board or International Reporting Financial Reporting Board. Secondly, you are allowed to change the accounting policies if when you change that policy, it's going to give you a reliable and more relevant information. In most questions that you're going to receive, this will be the case. When we read a question, we need to understand as to why the company is changing its accounting policy. And here I'm indicating to you that there are two ways you are allowed to change your accounting policy. Number one, when the board says you must change your policy. Secondly, when you as the director of the company decide to say, if we change from LIFO to FIFO, then this will give us more favorable results. In other words, where it will provide you with reliable and more relevant information, you are allowed to change. And again, I'm saying it again, this will be more or less the case in the scenarios that you're going to get when it comes to financial accounting 3B. We're almost at the end of dealing with the principles, and from here then we're going to go and look at the example. Everything that I've just stipulated to you now, we should be able to apply it. We should be able to apply it. So now let us look at the last part of our principles. So the standard stipulates that when you change your accounting policy, a change in accounting policies must be accounted for retrospectively. Let me repeat that. When you change your accounting policy, a change in accounting policy should be accounted for retrospectively. So what does this mean? What does this mean? Accounting for change in accounting policy retrospectively. So it means that if you are applying the retrospectively, now we are in 2021. So if you have information for 2020 and 2019, so in other words, if you have information for the last 3 years, and in 2021 you are changing your accounting policy, you must go back to 2020, 2019 and apply that change as if it has been like that before. This is interesting. We'll see it when we deal with the actual example. So a change in accounting policy should be accounted for retrospectively. In other words, if you change your accounting policy in 2021, you must go to 2020, 2019, 2018, provided that you have information and you apply the new policy. And it will have an impact. You will see it when you do the exam, it will have an impact. So now the question is, what if I only have 2021 and 2020 information and I don't have other prior information? The standard says apply to the extent that it is practicable, it is possible that you can go in the previous years. If not, then apply 2020 and 2021 and you move on. So that's all regarding the change in accounting policy. I'm looking here at my timeline. I don't see any questions so far. I hope all is well. I hope all is well. If you have any question, you're more than welcome to put it on the chat. If you want me to repeat anything, you're also more than welcome to type it on the chat there. I will do so. I will repeat the portion that you're missing. So that's all about the change in accounting policy. Just to recap, I'm going to recap as to what we talk about. So I indicated that at this level, what you can expect to deal with changes in accounting policy with regard to inventory valuation, as well as borrowing cost. But for today's purposes, we're only going to deal with inventory valuation. Then I also indicated that when can the company change its accounting policy? There are two ways or two allowable ways you can change your accounting policy. Number one, if the International Accounting Standard Board requires you to do so, you must change your accounting policy. Or if, as the business, you decide that if we change our accounting policy, it's going to give us a more reliable and more relevant information, then you can change your accounting policy. The last part, I've indicated that a change in accounting policy should be accounted for retrospectively. What does that mean? That means that you must go as back as possible, as long as the information is allowed, and you apply that new change as if it has always been like that. As if it has always been like that. So one last thing that I want to indicate is that don't forget that you will be expected to know how to prepare the statement of profit and loss and other comprehensive income, statement of changes in equity, change in accounting policy note. You will be expected to know how to calculate income tax and taxable income when it comes to change in accounting policy. Now, if there's any other question, if there's a question, you can type it on the chat. I'll keep on checking my chat here and I'll reply as such. Now we're going to look at the actual example. This example has been circulated through the class reps. Later on, it's going to be uploaded on my tutor. So if you go to my tutor, the same example, you're going to get it. The same examples, you're going to get it. So now, always when I look at the question, I always go straight to the required and try and find out what is required of me or of us to do. In this example, as I've indicated that all those 4 things you'll be expected to prepare. So they want you to prepare the statement of comprehensive income for Stage Limited for the year ended 31st December 2020. Statement of changes in equity as well for the same period. Thirdly, they want you to prepare change in accounting policy, a note, a disclosure note. The last part, they want us to calculate income tax and taxable income. So these are the 4 things I indicated at the beginning of this session that you are going to be expected to prepare. You're going to be expected to prepare. So the other parts on this thing is you must show all calculations and comparative figures are required. So as I go through this example, I'll be showing you the do's and the don'ts when you are responding to these type of questions. One thing that we always encounter when we're marking the scripts is that you will see that required number 1, it wants you to prepare the statement of comprehensive income, and required number 4 wants you to calculate the income tax expense and taxable income. So if you are responding to these questions and your information is just all over, when I receive your script to mark it, or whoever is making your script, and we can't see which one is required, you're responding. So your information is just all over. There's no differentiation between calculations and the required. What do you think is going to happen? So I keep on giving this example. If on calculations, there's depreciation that needs to be calculated, and also in the statement of profit and loss or any other statement, the depreciation needs to be disclosed, and you just calculate it and put it there, you don't indicate what is what, you're going to get 0. I'm telling you now. Don't do that. Make it clear to ever marking your script that this is my required number 1. Here I'm responding to my statement of changes in equity. Here is the calculations. There's no formula, but required you should indicate, because if your information is just all over, that means you're saying whoever's marking your script must go and look on the whole script. Unfortunately, you won't be awarded any marks. You won't. So think about it. If you're on the working environment and your boss say, can you prepare a statement of financial position for me? And you just go there, you don't even indicate that this is my statement of financial position. You just start saying assets, equity, and everything else, and the calculation, and they're all over. What do you think is going to happen? You're not gonna get any reward if there are bonuses. Here at school, we're not going to mark anything. You're going to get 0. I'm sorry, you're going to get 0. So make sure that you say, this is my required number 1. I'm responding to statement of comprehensive income. This is my required number 2. Here is my statement of changes in equity. Does it really matter? No, it doesn't matter. Even if you can start with calculation number 4, we'll be able to see it and give you the necessary mark you need. But make sure that things are clear. Calculations, whether they say show calculation or don't show calculation. Normally when they say show calculations, there will be marks for calculations. If you don't show any calculations, first thing that's going to happen to you is you're not going to get those marks. Secondly, if there are principal marks from the calculation to the statement and you didn't show calculations, you're not going to get the mark again. And that looks tough, but we're telling you now at the beginning to say, show all calculation. A good example is, let's say for example, here on the statement of comprehensive income, revenue amount that we want is 2 million. You go and calculate it and yours is 2.5 million. So that means on the calculations, you didn't get it right. It's 2.5 means 5, you didn't get it right. But if you transfer the 2.5 million to the statement and that mark is a principal mark, you are going to get it. You are going to get it. So I see someone say, can you please record this session? The session is being recorded. We started with that. The session is being recorded. So it's just that at the beginning, you'll see at the beginning where we started recording the session. So this session is currently being recorded. So it will be available. So I see there's another question again here on the timeline. Someone is indicating to us here and say, are there any slides being displayed currently? I don't see anything from my end. Yes, there are slides. I hope you guys, you can see the slides. I've indicated certain students indicated yes, we can see it. Here is the slides. Maybe just log out and log on again. Here's the slides, we are showing it. All right, so this is the required. As I've indicated, this is what will be expected of you guys. Please show your work neatly. Required number 1, let it be clear, this is my required number 1, this is my required number 2, 3, and required number 4 as well. Show also your calculations. When it comes to calculation, it doesn't matter whether you do it on the actual statement or you do it separately, but as long as you can show that this is my calculations, as long as you can show that this is my calculations, then we will do that. So someone will say, when are we getting these slides? Just after the class, I'm going to send to the class rep the slides. So you'll receive them today. You'll receive them today. All right, so let's continue. That's why I'm spending some time here on the required, because I'll be telling you the do's and the don'ts. So I'm saying to you, if they say show all calculations, you don't show calculations, you're going to lose the marks allocated for calculations. That's number 1. So already you've shot yourself in the foot. Secondly, if there are principal marks in any of this statement, if there are principal marks in any of the statement and you didn't show calculations, you're not going to get any if it is not correct. A good example that I was giving you, I'm saying, if revenue amount for 2020 is 2 million, that is the correct amount. If you put it there and you don't show calculations, you'll get 1 mark for putting it there, but for calculation, you won't get anything. But if you calculate a revenue and it's 2.5, which can happen, that's what you got, and you don't show calculations and you go and disclose it, you're not going to get any mark. Though it's a principal mark, because I don't see where you calculated your revenue from. So don't do that. Don't do that. All right, so someone has a question, say, should calculation be in specific format? The answer is no. Calculations are calculation. You will see here when we go through this example, I'll show you what do I mean by calculations. So but what you need to be specific is, if you're doing calculation for cost of sales, indicate as such. Don't just say calculations and then you start putting everything all together. Let's say, for example, if you're dealing with PPE, PPE has a lot of assets. Let's say there's a depreciation for equipment. There's a depreciation for plant. There's a depreciation for vehicles. And what you do is just go and say vehicles, and you don't indicate for which one. And you want me, when I'm marking through, say, no, this is for plant, this is. I'm not going to do that. You need to tell me that, here I'm calculating depreciation for equipment. Here I'm calculating depreciation for vehicles. It needs to be clear. So how you do it in a table, you don't do it in a table, that's irrelevant. As long as you can show me, here you're calculating depreciation. All right, so let's proceed. I see it's 1 o'clock. I want us to deal with this question. Give it time. I'll be telling you some of the technique you can use. If already you have yours, don't change it if it's working for you. But if you don't have one, you can adopt one. All right, so this is the required. I'm going to look at the required statement of comprehensive income, statement of changes in equity, disclosure note with regard to change in accounting policy, income tax expense and taxable income. This is what is required. So guys, please, when we say statement of changes in equity, we need statement of changes in equity. So you will find you're asking statement of changes in equity, someone goes there and give you a T account. Then you're not going to get any marks. And if I say statement of comprehensive income and you go there and do the statement of financial position, you're not going to get any marks. If you want the note in change in accounting policy and you don't give us change in accounting policy, you're going to get 0. If we say calculate income tax expense and taxable income here, and you go and do something else, you're not going to get any marks. So make sure you understand this. I believe, but now you know. At level 3, we expect you to know these statements. The difference between the statement of changes in equity and the note, disclosure note, the calculations. This one is clear. All right, so now let's look at this example. I'll try and go in detail and I'll try and explain the most important part. What do I mean by that? I'm not going to spend time on revenue. So we all know how to calculate revenue. We all know by now what comprises of revenue. So here we're given the statement of profit and loss and other comprehensive income. And if you recall, requirement number one want us to prepare the statement of profit and loss and other comprehensive income. See, why should we re-prepare it again? Because here's the information provided to us. So the format is given for you. So with this one, I expect everyone to get the format right because information is provided here. Right? It's given from turnover until profit and other comprehensive income. All this information is provided to us. Now, if this information is provided to us, why do they want us to prepare another statement of profit and loss and another comprehensive income? We'll see in the next slides why they want us to prepare it again. All right, additional information. This is where the important information is. And I can tell you now that every additional information provided to you has been provided for a reason. Let me repeat this. Every additional information provided to you, you should ask yourself, why are we given this information and what are we going to use this information for? So now let's read additional information number one. This is the crux of the matter. This is where the information is. And this is what we need to use to apply it in order for us to respond to the required. You will see when we do the calculation. I'll spend some time on the calculations, then I'll show you how does it impact the required. So during the current year, the company changed its accounting policy with regard to inventory valuation from last in, first out, which is LIFO, to weighted average to provide a reasonable estimate of cost price. Remember, on the principles I indicated to you, when can the company change its accounting policy? There were two things that you need to look at. When the international board states so, or when you see that it's going to give you relevant and reliable information, which is the case here. So this company, the directors decided to change its accounting policy with regard to inventory valuation from LIFO to weighted. Why did they do that? They did that because this is going to give them a reasonable estimate of cost price. So it's going to be favorable to them. That's why they did that. So now they give us the method there from 2018 to 2020, and they indicate to us, this is the old method, which is LIFO. This is the new method, which is weighted. This is the information provided to us. We'll spend more time and try to analyze all this information as to if they change an accounting policy, what is the impact on our financials? When I say financials, I'm referring to the components of financial statement, which is the statement of comprehensive income, statement of changes in equity, statement of financial position. Though, bear in mind here what we required. We are required to prepare the statement of profit and loss and other comprehensive income, statement of changes in equity, as well as the note. That is what was required. But all these change will have an impact on the financial statement. That is the whole purpose of dealing with this change in accounting policy, inventory valuation. So information is provided there, new method, old method. There was a change. When did that happen? It happened in 2020. And if you recall, I said, when you account for change in accounting policy, you account for it retrospectively. So in other words, you must also go back to 2019 and say, what is the impact of that change? 2018, what is the impact as well? Not discarding 2020. So those principles that I've shown you before on the slides, which I'm going to share just after the class with the class rep, it says to you that first thing first, when can you change your accounting policy? In this case, we know what is the reason why they're changing it. Secondly, say we must account it retrospectively. What it means is that we must go to 2019 and 2018 because information we have it. We'll go back and look at these calculations. Let's look at the next additional information. So the next additional information is indicating to us that SARS, which is South African Revenue Services, will allow the new inventory valuation method at the end of the current year. Deferred tax is provided on the comprehensive basis. SARS will not reopen prior assessment. The new method will be accepted at the end of the current year. This information is here for a reason. Let me explain what it means. So what it means is SARS is saying to you, I know that you change your accounting policy, but me as SARS, being SARS, I'm not going to reopen the previous years of assessment. I will only accept the new method in the current year. So SARS is saying to you that if you are in 2018 and you want to calculate your deferred tax, SARS is saying in your books, what I know is that you have 340,000 of inventory. I'm not going to recognize the new method. So already the difference between the two, you could see that it's going to give you a deferred tax. And remember, you don't just end up saying deferred tax. Deferred tax is either will result in a deferred tax liability or deferred tax assets. What does that mean? If you want to calculate deferred tax, you need the carrying amount, you need the tax base in order for you to calculate deferred tax. So SARS is saying to you, from tax point of view, these will be the tax base. Why? Because I'm not going to open it. And from business point of view, they're going to indicate in their book, say our new carrying amount is 380,000. And the SARS is saying, no, but we're not going to allow you in 2018. We still know 340. So carrying amount will be 380, tax base will be 340. And if you take carrying amount and you compare it with the tax value because it differs, then you're going to have a deferred tax. And in this case, because carrying amount is greater than the tax base, going to be a deferred tax liability. So now the question is, what if SARS is going to open the prior year of assessment? That becomes easier when it comes to deferred tax. SARS is saying to you, no, you have changed the method. We will accept the new value. So the carrying amount will be 380 and the tax base will be 380. In other words, there won't be deferred tax. Let me repeat that. Every information that you're given, it's very important and you're going to use it. Let me read this information again. SARS is saying that South African Revenue Services will allow the new inventory valuation method at the end of the current year. Deferred tax is provided on the comprehensive basis. SARS will not reopen prior assessments. The new method will be accepted at the end of the current year. And I was explaining that if they're not opening the prior assessment, SARS is saying to you, although you change your method, as far as I know, your inventory value is 340, though in a business you're saying it's 380. So the difference between the two will create deferred tax, either deferred tax liability or deferred tax asset. Same applies to 2019. SARS will apply the same thing, will say, we know that you change your method, but we don't accept it in 2019. So you must disclose as your tax base 300,000 and your carrying amount is 360. So there will be a difference again, which will result in deferred tax liability or assets. Lastly, SARS said, come 2020, I will accept your new method. In other words, I won't see your value as 120,000. Your value will be regarded as 200,000. So carrying amount will be 200,000, tax base will be 200,000, which give the zero at the end. So there's no deferred tax. All right, I hope that is clear. If not, type on the chat, I'll repeat it. But we're going to go through it again when you do the calculations. The next additional information, dividends declared, 2020, 80,000, 2019, 60,000. This is what we're given, right? It's fine, we're going to use it. You know that the dividends, you use it when you do your statement of changes in equity, right? And the other thing that I want to mention here is, are you aware that dividends reduces your profit or your retained earnings? So in order for you to understand this thing easily, it's the profit that you make during the year as a business. If you're doing accounting and it's yet year end and you've made a profit of 200 Rand, that profit will be transferred to equity or to retained earnings. And it's going to increase your retained earnings. I hope you know that by now. Profit you made, you're going to add it with your retained earnings, the open retained earnings if you have it. And dividends that you declared, dividends is declared on the profit, and dividends reduces your retained earnings. That's why they gave you. So when you do the statement of changes in equity, dividends is going to reduce your profit for the period, or it's going to be reduced on the statement of changes in equity. You will see that. Here's the point I want to spend some time on. Closing retained earnings 2020, 847,500. So always be on the outlook when they give you information. When it comes to retained earnings, what did they give you? Did they give you the opening on the closing? Look at this. They gave you the closing retained earnings at 2020, and here's the amount. Now, that means you need to calculate the opening retained earnings. Very important. You should be able to know how to calculate the opening retained earnings. Because we are given closing, so this is given. So how would one know how to calculate it? So someone is saying, please change the slide. I don't understand that. Let me just find out from the other guys. Do you still see the slides? If the slides still clear, you want me to close it and upload it again? Do you still see the slides? Because I see time is against us. We need to move on, but what we're going to do. Yeah, someone said, yes, I see the old slides. Okay. There's no new and old slide. This is the same slides that we're talking about here. This is the same slides we're talking about. It's just continuing. All right, thank you for that. So I was still explaining regarding the retained earnings, and there's a question you say, hi, what if the dividends is paid rather than declared? Will it affect our current statement of equity? All right, that's a good question. Dividend paid or declared, it doesn't matter. The dividends that is going to be reflected on a statement of changes in equity, it needs to be declared or paid, either way. So don't be confused when they say dividends declared and sometimes they say dividend paid. No, the timing of payment doesn't matter. When you're preparing your books, you need to show that here's the dividends declared. Normally, you know, with the dividends, what they do is you will have year end, and the directors and the shareholders will come have a meeting and say, we made profit, let's declare dividends. Let's say, for example, your year end is December, and they have a meeting in January. I'm just giving an example, or in December, but they say it will only be paid in January. So the timing of payment is irrelevant. As long as it has been declared, we count it as dividends. That is a dividend that's going to reduce our retained earnings. So when you do the reporting, it must show as such. Thank you for that question. All right, so now let's proceed. I was still explaining about closing retained earnings, and I said you must, once you're given the closing retained earnings, you should be able to calculate opening retained earnings. How does one do that? Make sure you know the structure or the framework of calculating that. That is the first calculation I will start with, because that is the easiest way. All the information is given to us. We can calculate the opening retained earnings. So let's look here at this information. This is the amount that we are given, closing balance of retained earnings. Here is my calculation. I want to calculate opening balance. This is what I want to calculate. I'm given closing balance of retained earnings at 847,500. This is what is given, right? In order for me to calculate the closing balance, I need opening balance plus profit for the year less dividends. It should give me closing balance. So don't worry about the amounts. I just wanted to explain here. In order for you to calculate retained earnings, you need opening balance plus profit for the year less dividends paid or declared. Then it should give you closing balance. So look here, we're solving for X here. This is what I'm given. I'm given the closing balance of 847,500. I don't have opening balance. But other information is given for me. Dividends paid for or declared for 2020 is 80,000. So you just come and fill it here. This is given, as I've indicated. Profit for the year, this is given. When you get the profit for the year, you go to the statement of profit and loss there. For 2020, it's 315,000. So all these three is given. The remaining is this one. So you can do the calculation. So you're solving for X. This is what you're solving. So if you have these three amounts, then you can calculate the opening. And there's your opening balance, 612,500. How was it calculated? Let me look at this thing. So I'm given 847,500. So if I add my dividends and I less my profit, it should give me my opening balances. And this opening balance, it means that it was the closing for 2019. Very important. It means that it was the closing for 2019. Then dividends is given again. Profit for the year is given again. Then you can calculate your opening balances. So again, I'm still saying, read carefully and see what is provided to you. What is provided to you? What was provided? It was the closing balance here. But you can work it backwards and get all these amounts. So don't be confused. So what happens if they give me the opening balance and they didn't give me the closing balance? You can calculate it as well. As long as you understand how to calculate the retained earnings. Opening balance plus profit less dividends is going to give you closing balance. That's all. So don't worry about the amounts. Yes, the amounts are given. So if it happens that they give you the opening balance, which will be on the 1st of January 2020, then you can fill the missing one. The missing one will be this one. I hope this is clear, and I believe everyone will get this right. When you write the assessment, the test, and everything else, make sure you practice as well. Make sure you practice. All right. So coming back to the big issue here, this is where I'll spend most of the time, and I'll explain as detailed as possible the do's and the don'ts. There are certain things that if you do them wrongly, you get 0, no matter whether you calculate it correctly or not. I'm going to show you now. So let's go back and look at this change in valuation method. So you will agree with me that we have a new method, we had an old method, and we have the figure. So the closing balance of inventory on the old method is this amount, 120, 300, 340. And now on the new method, it's 200, 360, 380. So I'm going to go straight to the calculations and explain line per line item. If you want me to repeat, please let me know. Here I am. Here's my table. Here's my calculations. Right? So you will realize that on the information which I was given from 2020 to 2018. The way I did my table, I started from 2018 going to 2020, 2018, 2019, 2020. New method, old method. What I did, you just take the closing balance as it is. In 2018, the new method is telling us the inventory is 380 and on the old is 340. Just take the information as it is. 2019, we apply the same principles. 360 new, 300 old. 200 new, 120 old. So far so good. So far, so good. So now let us look at closing inventory as to how do we determine the closing inventory. So the new method now is 380 and previously it was 340. So the difference between the two, in other words, if you take a new method and then you less the old method, you'll have 40,000 in 2018, 60,000 in 2019, and in 2020 you'll have 80,000. Right, this is great. So now the question that I'm going to ask you is, what happened to my inventory? Remember, this is the change in accounting policy, inventory valuation. What happened to my inventory? Previously in 2018, my inventory was 340, now it's 380. You will agree with me that my inventory has increased by 40,000. If I go and apply the same principles in 2019, it has increased by 60,000. If I go again in 2020, it has increased by 80,000. So now I'll respond to you. I know that someone said the tax is calculated from what. So now if you look at this thing, so I want you to understand this. If your inventory is an asset, and asset are disclosed in the statement of financial position. There's no doubt about it. Inventory is current assets is disclosed in the statement of financial position. Right. So now, if your inventory increases, what happened to your tax? That is the question you need to ask yourself. If inventory increases, are you going to pay more tax or are you going to pay less? That is the question you need to ask yourself. So you will realize that when it comes to the tax here, the said tax rate is 30%. So I took 40,000 multiplied by 30%, which it should give you 12,000. So you do the same with the 60, it will give you 18,000. And you do the same with 80, it will give you 24,000. But I'm going to respond to the question that I will ask you, because if you understand this logic, then disclosure should be easy. If my inventory, which is an asset, and it increases, what is going to happen to my tax? Will I pay more tax or less tax? So if your inventory increases, then it also increases your tax that you're going to pay. I'm going to repeat again. If your inventory increases, then your tax is going to increase as well. You'll see it when we go to the disclosure. So that I want us to understand this table as it is now, so that when we go to disclosure, it becomes easier. Let me go a step back. We all agree here in 2018 that the new method is saying value your inventory at 380, whereas the old method is saying value your inventory at 340. Now the question is, did my inventory increases or decreases? My inventory increases by 40,000. Great. Calculation is easier. Tax at 30% is 12,000. And as just said to you now that if your inventory increases, your tax is going to increase. You will pay more tax. You pay SARS more because your value of inventory increases. That's all I was saying. So I want to finish inventory, then we'll go to cost of sales, then we'll go to tax expense. So let's come here. So I was explaining that in 2018, my inventory increases. And in 2019, it also increases. In 2020, it also increases. So if you do this calculation, this is a good calculation, and if you do it and you do it right, and you don't indicate when you're writing whether inventory is increasing or decreasing, you're gonna get 0, no matter how correct your calculation it is. So make sure always, when it comes to inventory, which is this slide here, you don't necessarily need to do it this way. You can do it your way, but as long as you tell whoever is marking that my inventory in 2018 is increasing, in 2019 it's increasing as well, 2020 is increasing as well. But can the inventory decrease? Yes, it can decrease. Remember, we're just using the principles here. Let's go back to the principles. What about if this 340 was here as a new? and the old one was 380. It was going to lead to a decrease. So don't cram that inventory always increases. I know in most of the questions that we give you, inventory increases. Imagine you go to exam and now, boom, inventory is decreasing. And you go and write the inventory is increasing. That means mathematically it's wrong, because in accounting we work with the increase and decrease. So if you do the opposite, you get 0. So apply the principles. Once you apply the principles, it'll tell you if it was 340 here and 380 here, my inventory was going to decrease. And when inventory decreases, again, on the other side, my tax is going to decrease. The principle is the same as that. So don't memorize that inventory will always increases. No, it can decrease. It can decrease. Just that it's coincident here that it's increasing 2018, decreasing 2019, increasing 2020. You might find that it's increasing here and it's decreasing here and it's increasing here. It can happen. So, but the most important point I want to mention is that if you don't indicate whether it's increasing or decreasing, you're not going to get any marks, no matter how good your calculation is. You need to tell us what is happening to inventory. You will see when you go to the node what is happening to your tax. All right, I hope that is clear. So we're almost done with inventory. I'm going to go to cost of sales now. I'm going to go back here and deal with cost of sales. So the way you calculate cost of sales, the cost of sales deals with the differences in the closing inventory. I'm going to show it here. So you have 20,000 and 20,000. I'm going to explain it in the next slides as to what is the impact. So someone say, what is the fundamental reason behind the increase or the decrease? Okay, so think about it this way. When you change your accounting policy, you will have seen that it says you change it so that it can give you the benefit. You can see that this company changes accounting policy because they saw that if they use the new method, their inventory is going to increase. So when it increases and increases, it improves their books. So when you go to their financial statement, previously you will see that it was 340. Now, all of a sudden, their current assets inventory is 380,000. So it improves their current assets, which will lead to the working capital at the end. So that's why they're doing that. I hope that answers your question. That's why they do. Why are they changing it? Because it's going to improve their financial. When you look at the financials, they'll have good inventory amount, which means a lot, because for those of you who does the ratios, you will see when you do the current ratio and all that stuff, it improves, it changes drastically. But for the purpose of this course, a good question. Yes, that's why they keep on changing it. But the main aim that we're testing you, say we want to find out from you guys, do you know whether this will lead to an increase or decrease in inventory? So if you do all these calculations and you don't indicate whether it's an increase or decrease, then for me, you haven't tell me anything. That means you don't know what is the impact on the financial statement. All right. So going back to cost of sales. Cost of sales, let's start here on this line. In order for you to calculate cost of sales, you need your opening balances of inventory, you add your purchases, and you less your closing inventory. Then you'll get your cost of sales. That is very important. Very important. For those of you who are doing cost and management accounting, I'm not sure about the other guys who are doing internal audit, whether you do. You see, this is how cost of sales is calculated from management point of view. Opening balances plus purchases less closing. This is very important. So now we want to determine whether our cost of sales has increased or decreased. That's what we want to determine here. The cost of sales increases or decreases. So the most important thing here is we're going to deal with the movement between the years. What do I mean by that? If you come to 2018 year, there's no 2017. So that means the opening balance, it will be 0 because we don't have any figures. Purchases, because it was just changing accounting policies, there's no purchases. So throughout, you will see it from 2018 until 2028, there is no purchases. So 2018, no value for opening, purchases 0 as well. Closing 40,000. Where do we get that 40,000 from? Here's the 40,000 for 2018 inventory. The closing, the movement, it is 40,000. That is the amount which is it. So if it is closing year, it's going to be opening for the next financial year. Now, let's determine here whether cost of sales increases or decreases. Let's determine here whether cost of sales increases or decreases. So it's 0 plus 0 less 40,000 is going to give us negative 40,000. So our cost of sales has decreased in 2018. Let's go to 2019. Opening, I've explained, that is the closing year. Purchases, 0, because we're just dealing with the change in accounting policy. Then, if I come here, what was the closing for 2019? 60,000. There's the 60,000. Then it gives me negative 20,000, and it tells me it's a decrease in cost of sales. And remember, cost of sales is an expense. It goes to the statement of profit and loss. That is very important. That's why I keep on saying inventory, assets, statement of financial position. Cost of sales, expense, goes to the statement of profit and loss and other comprehensive income. So the closing 60,000 will be the opening. Now we need to get what was the closing for 2020, 80,000. Where do we get 80,000? Here is the 80,000. And then give me negative 20,000, which is a decrease. So that's all about cost of sales. So my cost of sales from 2018 until 2020 has decreased. So does that mean, like, okay, think about it this way. Inventory was increasing across the board. Cost of sales now is decreasing. Don't fall into the trap where you do the next question. You assume that inventory will increase and cost of sales will decrease. No. Apply this principle. It will tell you whether it's increasing or decreasing. You might find out that inventory is increasing and cost of sales is increasing at the same time. It can happen. Apply the principles, apply the formulas, you'll get it, always get it right. If you don't apply this, I can tell you, you will struggle. But if you apply this, yes. Again, cost of sales, tell me whether it's increasing or decreasing. If you do all these calculations and you don't go and indicate here, this portion, you don't indicate whether it's increasing or decreasing, and you get it right, you're gonna get 0 because you haven't talked to me. It's cost of sales increasing or decreasing. That's what we want to know, because it will have an impact on your statement. So someone will say, can you please repeat from the beginning on cost of sales? Yeah, I'll quickly do that. Thank you for that question. All right, let's start from cost of sales. I know those who are doing cost management accounting, I'm not sure about others, that think about it. For management, in order for you to calculate cost of sales, you take your opening balance of inventory, you add what you've purchased during the year, and you less the closing balance of inventory. That's what you do for you to calculate cost of sales. Let me repeat that. The most important thing is to know this formula here. Opening balances plus purchases less closing. Do you need to show it in the table? No, not necessarily. As long as you can understand it, and you can show it. I just decided to put it on the table here because I have various financial period. Opening balance plus purchases less closing to give you cost of sales. So I haven't talked about the increase and the decrease. So now, because there's a change in accounting policy, let's come back here. There's a change in accounting policy. All right. I want to deal with the movement of my inventory. I'm not going to deal with the full the movement. And here's the movement here. Here. Here's my movement here. It says when inventory changes from 380 to 340, then my closing inventory, I have inventory of 40,000. This is the closing. So already closing, you have it. So let's start from 2018. If I go to 2018, my closing should be 40,000. This is what I'm doing. 40,000. 2019, my closing should be 60,000. 60,000. And then 2020, here's my closing, should be 80,000. So this part, we dealt with it. So if I'm still here, I'm saying if my closing is 40,000, it's going to be my opening inventory in 2019. I guess you agree with that. Your closing is going to be opening for next year. So you can see that we just cross-referencing it here, 40,000. Again here, 2019 closing is 60,000. That means the opening is going to be 60,000. We're almost done with this thing. So let's go and deal with the purchases. There is no purchases because there's a change in inventory valuation. Yeah, it's always be zero because of it is a change. Now here is the opening. Where's the opening for 2018? 2018, we don't have 2017, so we'll assume that it is zero. We'll assume that it is zero. So someone said the increase or decrease in cost sale. What do they mean? Good question. So now think about it this way. If you're running a business, you go and you buy inventory at cost. But when you take that inventory, let's say you buy inventory at 200. So when you buy inventory at 200, how much are you going to sell that inventory at? So you buy by 200. Let's say, for example, you go to Macro. You buy your inventory at Macro. When you go there, you have transport. You include your transport and so on. So when you come back, you say, how much did it cost you to sell that inventory? Then you will include all those assets. So the change in inventory valuation will also have an impact in the cost of sales. Always. Now we want to know whether that impact is it positive or negative. That's what we want to know. Is it positive or negative? So here the cost of sales decreases. So when the cost of sales decreases, then what does that mean? Is it good for a business or bad for business? So remember, cost of sales is an expense. When expenses decreases, it increases your profit. So overall, when the company, you guys, when they appoint you to be consultant and then you have a business and you analyze, you look that this business is using this model of inventory. If they change it, what will be the benefit? They'll have more profit. They'll have more inventory in the financials. That's why we say, if you know it's going to benefit you, you're going to change that model. For example, here, cost of sales decreases. It's a cost decreases. It's a good thing. That means that your profit is going to increase. And when your profit increases, and the tough part that your tax also increases. I don't worry about tax about now. It's just that your profit is going to increase. When your profit, okay, when your cost decreases, it increases your profit. And when your profit increases, it increases your tax. That is very important. Very important. You need to understand that because you will see it when we go to the note here now. You will see it when we go to the note. So, having said that, I saw there's a question. I'll get back to the question. Let us just recap here. Inventory, we agreed, has increased. Cost of sales, decrease. We just dealt with that. Tax expense now. what's going to happen to tax expense? We take 40,000 and we multiply it by 30%. We do the same with the 20. This is the figures we're going to get. So this is what I was explaining. When your cost of sales decreases, your profit increases. And when your profit increases, your tax that you're going to pay increases. This is the relationship. This relationship is very important for one to understand. You can prove it. You can do your revenue until the line item profit before tax or profit after tax. And you just go and change any of the line item on the expenses and tell me what you see on your profit. Your profit is going to increase. That you can practice it. The sooner you understand it, the better, because it will be very important when you go to the disclosure. So here, and that calculation, this is the summary of everything that we did there, or the calculations. Inventory increases. Now the question is, do you really need to do it this way? It's up to you. The calculation can be short, can be long, but this is what we want to see. We want to know what happened to inventory in 2018. It has increased. What happened to cost of sales in 2018? It has decreased. So what happened to the tax expense? It has increased. All right. Let's proceed. We almost at the end of our session. We're almost at the end of our session. So let's proceed here. Well, let's go back to the required and see what was required. Now I'm going to explain all this calculation. How does it impact whatever we required? Remember, we're given the statement of profit and loss, and then we're required to prepare it, right? It's very important. So let's start here. I want us to start here. We spoke about the cost of sales, right? These cost of sales, this is the amount that was given on the previous statement of comparison income. And we agreed that cost of sales in 2020 is going to decrease by 20,000. And in 2019 is going to decrease by 20,000. Where do I get that information from? Here's the information. Let's start here. Cost of sales, 2020 is 400,000. 2019 is 425,000. So I did a calculation here, which is not necessary, but for explaining, I want you to understand how cost of sales was calculated. 400,000 for 25. You saw where this information is from. And if we go to the change in accounting policy, I've said to you, the change in accounting policy, if I come to 2020, cost of sales is decreasing by 20,000 and cost of sales is decreasing by 20,000 as well. Right? So we can agree with that cost of sales indeed is decreasing by 20,000. So if I come here, cost of sales 20,000 decrease, cost of sales decreasing by 20,000. So all in all, the total impact is 380,000 for cost of sales, 405,000. So if you come here, here's the amount that I'm talking about here. You see, the calculation doesn't matter where you put it. You can do it separately, you can do it on the face. It doesn't matter. If you put it correctly, we're still going to give you. It doesn't matter whether the calculation is on the other side or here. But I just want to show you what was the impact of that cost of sales in the statement of profit and loss, which is the impact here. Very important. All right, great. Let's move along. I want us to spend time here in this note. Once we're done with this note, then we can go to the statement of changes in equity. So I'm going to say it again. This information here that is given here, you must know it by heart. And if you attend my classes and you practice, please don't disappoint me and don't get these marks, because these are easy marks. So let me read to you what it is saying and go and make sure you understand it. During the year, the company changed its accounting policy with regard to the inventory valuation from last in, first out method to weighted average method. Why did they change it? To provide a reasonable estimate of cost price. Let me stop there. Let me stop there and go back to the question again. So that information that I just read for you is this information here. So you just need to know where to disclose it. Even when they say 5 minutes left and now you're still struggling with the note, you should be able to get it right. There's the information. As it is here in the note. So ladies and gentlemen, please, I'm begging you, it's painful. This is easy. As it is, here it is. Don't do anything, you just need to go and know that it's going to be on the change in accounting policy note. It further stated that the change in accounting policy was accounted for retrospectively. At the beginning, I've indicated to you that you must account for change in accounting policy retrospectively. And the comparative amounts have been appropriately restated. The effect of the change in accounting policy is as follows. It is as follows. Let's start. So there will be an effect on the statement of comprehensive income because of cost of sales. There will be an effect on the statement of financial position because of inventory. All this is based on the calculations. Let me come back here. Let me come back here. Let me come back here. Inventory, statement of financial position. Cost of sales, statement of profit and loss. We can agree with that. So if you come here to the note, effect on the statement of comprehensive income, so we're referring to cost of sales. Effect on the statement of financial position, we're talking about inventory. Ladies and gentlemen, if you understand this, and you know how to apply it, you will never get it wrong, never. I've seen a lot of people who do the calculation correctly. When it comes to the disclosure, they lose all the marks. Think about it this way. We indicated that inventory has increased. What about if you come and say decrease in inventory? You get 0, no matter whether the marks are correct, the amounts are correct or not. You get 0. Think about it. Whatever you did in the calculation is what we need to reflect here. Let me start with inventory. Inventory in 2020, it has increased. Here it is. Increase in inventory. 80,000, 60,000. It is from the calculations. And I've said to you, what is going to happen to tax when inventory increases? When inventory increases, then that means the tax, which is our liability that we're owing SARS, is going to increase. It has increased here by 24,000, 18,000. All these amounts are from here in the table. Once you have this table, you have everything. Let me show you here. We agree that in 2020, inventory has increased by 80,000. So that means tax also increased by 24,000. That is 2020. I'm going to show you 2020 in the disclosure note then. Here is 2020. Inventory, 80, and then 24,000. That's the amount from the calculations. So now, what does that do? If inventory increase and the tax increases, it means retained earnings also increases by the difference between the tax and the inventory amount. So this is the difference here. If I go to my calculations here is the 56,000. So that means my retained earnings is going to increase by 50,000. So in other words, if you do it well in these calculations, you understand what you're doing, you can't get it wrong on the other side. You can't. So the same will apply to 2019. 60,000, 18,000, 42,000. Increase in equity. So increase, increase, increase. An increase in asset will lead to an increase in the tax that we're going to pay, will also lead to an increase in retained earnings. Very important to understand that principles. Then adjustment against retained earnings at the beginning of 2019, because we don't have 2018, it's 28,000. Where do we get that 28,000 from? Here's the 28,000 year for prior year. It is 28,000. So we're done with the part of the statement of financial position. Let's go with the statement of comprehensive income. Let's talk about cost of sales. What did we say about cost of sales? Cost of sales is an expense. We all agree with that. And we said cost of sales has decreased in 2020 and 2019 by 20,000. And in turn, because it has decreased, it has led to an increase in tax, and it will lead to increase in profit. All these amounts, we have it here. Here, 20,000, 20,000, 6,000 tax, and 6,000 tax. So that means our profit is going to increase by 14,000 and 14,000. Any question up to so far? We're almost done, ladies and gentlemen. As long as we can interpret our calculations and what is the impact. This is the impact on the statement of comprehensive income. Cost of sales will also show it on the other side. Unfortunately, we're not required with the statement of financial position. Our inventory is going to increase by this amount. All right. So now let's go to the statement of changes in equity. This is the most interesting one. Let me start with the easy marks. It is very painful to see that people lose marks like dividends declared. So statement of changes in equity, in this case, we'll only be dealing with retained earnings, only because we don't have share capital and all other stuff that are put on the statement of changes in equity. Think about it as dividend declared. Always get this right. Always, ladies and gentlemen. This is given. And then I'm going to look at this retained earnings as previously stated. This is what we calculated. This is the first calculation that I explained to you, that you must calculate the opening retained earnings. 2019, 200,000, 612, 500. This is the calculation I'm referring to here. This is the calculation that I did. It is disclosed on the statement of changes in equity. So 20,000, 612, 500, we dealt with it. Dividends declared 80,000 and 60,000. What about total comprehensive income? Total comprehensive income, you must go and take these amounts from the statement that you're going to prepare, the new statement that you're going to prepare. You take them there. Those are the profit for the year. Change in accounting policy, very important. So what happened? This is what I want to explain, because positive and negative can make you to get marks or not to get marks. Let me explain it this way. Retained earnings, closing balance. So I indicated to you that retained earnings has increased. So retained earnings, we're talking about the opening balance. So I will say to you the opening balance for 2019 is 28,000 and the opening balance for 2020 is 42,000. Let me come back here to this calculation so that it makes sense. This 28,000 is the retained earnings. It will be the opening of 2019. And this 42,000 will be the opening of 2020. So when it comes to the statement of changes in equity here, in 2019, it has increased by 28,000, which is the amount for the closing of 2018. And it also has increased by 42,000, which is the amount of closing of 2019. And that completes our statement of changes in equity. Any question? I see time is against us. Any question? Ladies and gentlemen, any question so that I can repeat anything you want me to repeat? Okay, the last part is with regard to taxable income. So I'm not going to explain that because we did the taxable income. Probably in the next session, I will start with that. And that will be on Wednesday from 2 o'clock until 3:30. If there's no any further question, then that will be the end of our class. This session has been recorded. The moment I stop it, the record is going to appear. You can use the same link to go and check all the recordings. Any question? I'm still here. If you have any question, you can type it. I'll give it until 2:10. I'll still be. I'll assist you with any question. These slides automatically, I'm going to send it to the class rep, so you will receive it right away. So someone say, where can we get the recording? You use the same link. The moment I close this link, the recording is going to appear. The moment I close this, the recording, you just use the same link, you get the recordings. You will see the recordings. They're going to come. Maybe they can take plus or minus 10 minutes, but the recording is going to come. Not on my tutor. So this link is also there on my tutor. If you log on to my tutor, and you go to online class, you will see there is you'll see there's a content area called online classes, and if you click there, it will take you back to this link on my tutor. Any other question? Any other question? I'm giving you until 10 past. Is it possible to download? Yes, it is possible to download. It is. You will have access. If you're struggling to download, let me know. I'll download it for you. It is possible to download. Any other question? Okay, you're more than welcome to put it on the chat there. More than welcome to put it on the chat. I'm still here. Anything you want me to clear for you, you're more than welcome to put it there. So I see the question say, are we going to have assessment to get predicate, or we write assessment and you give us the final mark? All right, that's a good question. At the moment, the university is still finalizing. Due to this COVID, the biggest challenge, the biggest chances is that you're going to write everything online. Final assessment and the test you're going to write online and submit it. So there won't be like last semester where you have to come and sit down. But at the moment, I don't want to jump the gun. I want them to finalize and give us proper communication. Then we'll communicate with you how you're going to be assessed. Because I don't want to come and say, no, you will write online, and later on they come and say, but you will have a sitting exam. Or I said you will have a sitting exam, and later on they come and say, no, everything will be done online. So my advice is every test, every assignment, every assessment, take it seriously, because at the end it might count against your final mark. So if you say test one, let's say for example you're going to write for argument's sake end of February or in the mid-February, go and write and give it your best, because that could count towards your final mark. So, but the details will come back with it once the university has endorsed it. I believe they will also share it with the students. We'll also share it with you guys. This is how you're going to be assessed. When is the first assessment? We'll let you know. We'll let you know when there's time. We'll let you know. Let us just be patient and wait for the university to finalize that. We'll tell you in time, but in the meantime, whatever we're doing, keep on practicing. Then it's going to make your life easier when it comes to this course. Thank you for those questions. Any other question? Will it apply to first semester exit or sub? Well, I'm not sure. You know, with this COVID challenge, I'm not even sure whether the exit or sub will be written online or sitting. I'm not sure, but let us just be patient. I know that before the end of January, everything will be clear as to whether exit, supplementary, how it's going to be written. All right, are we going to get study pack this time? I'm not sure whether we're gonna get the study pack. The only thing that I can tell you is that everything that was supposed to be on the study pack will be uploaded on my tutor, topic per topic. So before the end of this week, we should update, we shall upload everything that has to do with this topic, even the next topic. How many topics or chapters are we doing this semester? Yeah, this semester is quite a lot. Let me quickly count for you. Changes in accounting policy, borrowing cost, and we have cash flow, and we have consolidation, we have foreign. 1, 2, 3, 4, 5. We have 5 topics that we're going to deal with this semester. I can tell you other topics are very short. For example, borrowing costs and foreign exchange topic is very short. But consolidation, changes in accounting policy, and cash flow, those are the long one. After the update, can you please update the study guide so that we can always refer to it if you want to know anything in regard? Yes, most definitely. Don't worry, whatever will be agreed on, going to be uploaded on my tutor. We'll share it with the class rep as well. You will know, you will be rest assured, you will know about how the weighting is going to work. Any question? You're welcome. You're welcome. I hope to see you guys on Wednesday. We have quite a lot to cover. So please attend each and every session. Even if you miss one, the recordings will be there. Go listen to the recordings. If it happens that we require additional classes, we will communicate in due time. What time on Wednesday? On Wednesday, we're meeting from 2 until 3:30. 2 until 3:30. Wednesday, 2 to 3:30. Monday, 12:30 to 2 o'clock. Someone said, is it possible to download the recording? Yes, it is possible. It is possible. If you're stuck and you can't download it, just let the class rep, and I will download it and send it. I'll download it and send it by the class rep. All right, ladies and gentlemen, I'm going to leave the meeting. The moment I leave the meeting, I see there's a message. Don't we have an official timetable for all our models for this semester? We have it. You didn't receive it. We have the official timetable. You didn't receive it. It's fine. For financial accounting 3, I'm going to send you for financial accounting 3. I'm not okay. Let me find out from the other lecturers, because I have the timetable for all internal audit, but for accounting only, and the tax. I'm going to send, but let me send you what we're having from my side. Right away after this meeting, I'm going to send it to the class rep. You will receive it. And thank you for that. Okay, I'm leaving, guys. All the best, and thank you for joining us.